1958.
Yeah, 1958. It's not just some dusty old letter. It really gives you a window into how he was thinking during a pretty interesting market period.
Absolutely. It's fascinating.
So if you're listening in, maybe prepping for a meeting, brushing up on finance, or you're just curious, this letter is gold. We're talking market psychology, value investing basics.
And a real case study of his strategy back then?
Exactly. You might have some real aha moments about, taking that long-term view on investing.
So let's set the scene. What was the market actually like in 1958, according to Buffett? What was the vibe?
Well, he kicks off quoting a friend, someone who ran an investment trust, who called the market exuberant.
Exuberant. That definitely paints a picture.
Right. And Buffett clearly felt that too. He wrote that almost any reason has been seized upon to justify investing. Sounds like a lot of hype, maybe a bit disconnected from reality.
Yeah, like sentiment was driving things more than maybe fundamentals were. That's a key idea right there. Market mood versus, what a business is actually worth.
He saw lots of new people jumping in looking for quick profits, right?
Exactly. He observed that influx. And what did he think the risk was with all that excitement?
Well, he basically warned that this belief, this widespread idea that stocks had to go up, would eventually cause problems.
Uh-huh.
And here's the interesting part. He thought that if things turned sour, even the undervalued stocks, the ones actually cheap relative to their worth, could get dragged down by the general pessimism.
Even if the business itself was still solid.
Exactly. Price versus intrinsic value. That's the core distinction he was making.
A really crucial point. Market price is fickle, emotional. Intrinsic value is about the business itself. Okay, so in this exuberant market, how did his own partnership actually do? What was he expecting going into 58?
He'd said before that he expected to do better if the market was down or flat.
Right.
And if the market went up a lot, like it did, he'd be happy just to kind of keep pace.
And what were the actual numbers?
Well, the Dow Jones index shot up 38.5%. Pretty huge gain.
Wow, okay. And Buffett's partnerships?
They actually did a bit better on average. The range was 36.7% up to 46.2%.
So slightly ahead. And how did he feel about that result?
He called it reasonably good, which sounds maybe a bit understated, but...
Considering the market was flying.
Right. But he pointed out that a good chunk of their money was in things that don't usually soar when the whole market's booming. So keeping pace or slightly beating it was actually quite good for his strategy.
That really highlights his long-term game, doesn't it? He wasn't just chasing the hot stocks.
Not at all. He repeated his basic philosophy. Do better than average when markets are tough or level, and try to keep up when they're roaring ahead.
Okay, so let's get concrete. To really see this in action, he talks about a specific investment. Commonwealth Trust Co.
Right, Commonwealth Trust. This was their biggest holding at the time, he said. What was the story there? What made it attractive?
Okay, so his analysis conservative. He said put the bank's real value, its intrinsic value, at about $125 per share.
$125. And what was it trading for?
Only around $50 a share.
Wow, that's a huge gap, a big margin of safety, as they say.
Yeah, exactly. And the main reason for that discount, the bank was making decent money, like $10 a share in earnings, but it wasn't paying any of it out as cash dividends.
Ah, okay. So profitable bank, seemed well run, but the market wasn't giving it credit because shareholders weren't getting that cash payout. He saw an inefficiency.
Spot on. Plus, he mentioned the management was cooperative and he didn't see much risk of losing big money. And there was another layer too.
What was that?
A bigger bank actually owned about a quarter, 25.5% of Commonwealth. And they'd wanted to merge for years.
But it hadn't happened?
Nope. Blocked for personal reasons, as Buffett put it. But he saw that potential merger as a possible catalyst, something that could eventually force the market to recognize the bank's true value.
So you've got the cheap price, the solid business, and this potential trigger for the value to be unlocked.
Yeah.
Makes sense. How did he actually go about investing in it?
Slowly, patiently. Over about a year, they built up a position, roughly 12% of the bank.
Yep.
And their average cost was around $51 per share. And here's a key thing he points out.
Yeah.
It was actually good for them that the stock price didn't move much while they were buying. It let them accumulate more shares cheaply.
Right, that makes sense. It's patience and discipline again. He wasn't trying to time a quick pop. He was building a stake.
Exactly. And this wasn't a heavily traded stock. He mentions only about 300 shareholders, very little activity. So even small buy orders could have pushed the price up if they weren't careful.
Which is why he probably kept it quiet, right? Didn't want to drive up his own purchase price.
Precisely. But eventually, they did sell. What prompted the sale?
They found something else. Late in the year, another investment opportunity came up, one where they could become the biggest shareholder.
Okay.
So they sold their Commonwealth stake for $80 a share.
$80. Nice gain from $51.
Yeah, a solid return.
Yeah.
But he also adds a note of caution, calling the timing somewhat fortuitous.
Right. He emphasizes you can't really judge performance based on just 1 year. He would have been fine continuing to buy Commonwealth slowly, even if it meant lagging the market that specific year.
Because the long-term value was there.
Exactly. His focus was on that long-term picture. He even says the buyer at $80 might still do well over time, but, the deal wasn't nearly as compelling as it was down at $50.
It really drives home that margin of safety idea, doesn't it? Buying way below your estimate of value gives you that cushion.
Absolutely. Okay, so he sells Commonwealth. Then he mentions this new, larger investment that replaced it. What did he say about that one?
Well, it was a big position, about 25% of the partnership's total assets. Even bigger than Commonwealth had been.
A quarter of their assets in one company. Wow.
Yeah. He noted that maybe the undervaluation wasn't dramatically better than some other things they owned.
Right.
But because they owned such a big chunk, they had more potential influence, more say in maybe when that value would get unlocked or recognized.
Some more control over the catalyst, potentially.
Seems like it. He sounded pretty confident, said he expected this new holding to beat the Dow. So it shows a bit of a shift, maybe building on the Commonwealth experience.
Right, moving maybe from just finding value to sometimes helping create the catalyst. How did he frame this in terms of the overall market at the end of 1958?
Well, he observed that with the market being higher overall, those really obvious, deeply undervalued stocks were just harder to find.
Makes sense. Less low-hanging fruit.
Yeah. He mentioned he preferred workouts, those situations like mergers or liquidations where the outcome is a bit more predictable. But he wasn't finding many of those on good terms.
So what was the alternative?
His strategy became essentially to create his own workouts by taking these really large stakes in companies he saw as undervalued.
Trying to become the catalyst himself, like you said.
Exactly. And he ties this back to his earlier prediction about performance.
How so?
He specifically said this strategy, buying big chunks of undervalued companies, should lead to better than average results if or when the market turns down.
Okay, so that's the real test he set for himself. Judge me when the market's not flying high.
That seems to be the message. It's a great reminder, isn't it? Market moods swing wildly, but focusing on what a business is actually worth, that seems pretty timeless.
Definitely a timeless strategy.
Okay, so let's wrap up this deep dive into Buffett's 1958 thoughts. What are the big takeaways for you, for our listeners?
Well, I think there are a few key things. First, just how clearly he saw that gap between the market's mood, that exuberance, and the underlying value.
Right, don't get swept up in the hype.
Exactly. Second, the sheer patience required for value investing, really waiting for that value to be recognized, not forcing it.
It's not a get-rich-quick scheme.
Not at all. And third, how he was actively looking for and even trying to create those undervalued opportunities, especially when the overall market felt expensive.
Yeah, that aha moment for me is really seeing how crucial it is to look past all the daily market noise, the ups and downs, and really focus on the fundamental worth of the business itself.
Spot on. And it's a principle that's just as relevant now as it was in 1958, wouldn't you say?
Absolutely. So here's something to think about, maybe mull over after listening. Considering Buffett's view back then on market psychology and finding value, what does that make you think about your own approach today or how you understand these market cycles?
That's a great question to leave people with, digging into these core value investing ideas or even just looking at historical market trends. There's so much to learn there.
For sure. Well, thanks for joining us on this deep dive into a fascinating